Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It is lecture time, and this week's topic, guys, is about not giving up on your trades. A lot of you guys are giving up on your trades too soon. For example, you get into a trade, maybe it goes up a little, down a little, and ultimately it stops you out. And what happens? You slam your fist on the desk, you get pissed off, you get upset, and then you don't look at that stock ever again. All right. Or you maybe look at it again and now it's at your target or $3 or $4 past your target. And you're like, oh, I shoulda, I woulda, I could have gotten back in this thing and I didn't. Why? You're letting your emotions dominate your trading. Okay. So what's happening is some of you are getting into a trade, you're stopping out on it, and then you're like, well, it can't be that good. It stopped me out. Right. So what's happening is you're letting your emotions dictate your clarity. And because you're emotional, you don't have any clarity, you lack clarity. And that trade most likely is still a good stock. It's probably still decent. So meaning you were probably right, but your timing was off just a little bit. Okay. So some people will just ignore the stock or they'll take it off their watch list. Oh, that's junk. I'm never trading that thing again. And they have this aversion for some strange reason. It's like, I'm allowed to lose on two different stock symbols. I'm allowed to lose on Target and Microsoft. But, oh, God forbid if I lose on Microsoft twice. Well, what's the difference? Minus 2R is minus 2R. It doesn't matter if it's the same stock symbol or a different stock symbol, okay? So today we're going to talk about not giving up on your trades. And I'm going to show you guys that when a trade stops out, that sometimes there are even better entries the second time around. No, I'm not talking about the 84% rule, okay? We're not even going to touch upon that today. We're going to talk about sticking with it, especially if you think it has a nice gap, a nice daily chart, not giving up on it, because I'm going to show you 5 or 10 trades that didn't work the first time, but worked really, really well the second time, even better, all right? So stop giving up on your trades, all right? So I'm Jared Wesley of Live Traders. If you like these videos, please click the like button, hammer that subscribe button. Let's get to it. This week's lecture topic is don't give up on your trades, right? Don't give up on those trades. I'm finding, and I don't believe, in my opinion, I don't believe this is a lack of focus problem. I believe it's a mental block, okay? And what I mean is there's a lot of traders out there that will take a trade, maybe it goes well, maybe it doesn't go well, they'll stop out on it, and then they'll just not revisit that symbol ever again. Or at the end of the day, if they happen to come across that symbol again and it's, $5 higher, they'll sit there and go, I knew it, right? So we're going to talk a little bit about that today because I think you guys are missing high quality opportunities. And I'll be honest with you, and I don't want this to come out, contentious or anything, but I think Unwall sometimes is guilty of this as well, right? I mean, we don't see him getting back in the same stock very often, right? He watches the same stock for 5 days or a week at a time, 2 weeks at a time, but sometimes he won't get back into a trade. I mean, he will sometimes. So I think we're all guilty. I'm guilty of it as well from time to time, but I think there's a reason we're looking at certain stocks every day, correct? There's a reason for that. So let's show those stocks that we're looking at the respect they deserve, which means keep an eye on them, pay attention to them, even if they don't give us exactly what we want, or even if we take them and they do stop us out. But before we get into don't give up on your trades, we first have to talk about when will the insanity stop? So yesterday I was telling you guys that I had an interesting one for you today, one that I hadn't done before. And, well, it's new, right? I cannot stand, if there is one thing in life that bothers me more than just about anything else, it is victimhood. I cannot stand it. There's no positive outcome for being a victim in anything, okay? You have to take responsibility for your actions. Okay, this person did something, they acted on something, and it didn't go the way they had hoped or thought, and now they're blaming everyone else. Now, let's be fair here, okay? Let's be fair. What if, hypothetically, what if this person tripled their money? What if this person tripled their money? Do you think for 1 second that they'd be cutting their broker a check and saying, hey, thanks for the great advice. Here's 10%, here's 20%, here's 30%? Hell no. They wouldn't be saying anything, but I have the best broker in the world. But now they lost it all trading. What are my options? I feel that I was unjustly preyed upon and put in a position to lose a lot of money trading options on Tastyworks. As it stands, I have lost it all. And then some that I didn't have, and my wife's too. So you have no responsibility for this whatsoever. All of your money and then some, and your wife's too. Fascinating. Okay. What options do I have now to recover my funds? All right. Thinking of filing a complaint through Yelp or maybe a service like that for the financial community? Surely there is a one-time, guys. Surely there's a one-time process for reversing a series of poorly performing trades. I can't even read this with a straight face, especially if the investor was not qualified to make them. How do people usually fix this? Like, to me, part of this thinks, is this a hoax? Is this a joke? You know what the problem is, though? On a serious note, like a very serious note? The SEC and FINRA will look at this, and they'll use this as justification to make it harder for normal people who don't play the victim to get accounts. They will. This will make it harder for you and I to get a trading account. You want to know why they have a $25,000 PDT rule limit for people like this? Why in the world should the government be able to tell me how much money I need in my account to gain leverage? What difference does it make? What if I have $1 million or if I have $10? It shouldn't make any damn bit of difference. You can blow it all no matter what. Even if you have $25,000, you can put it in a real dog shit stock and lose all of it, couldn't you? The point is these types of comments, these types of people complaining make it harder for everyone else. It's the same reason we go through security at the airport, right? You take a few bad people and they ruin it for everyone else. Okay? This is some big ass horse shit right here. This person should be embarrassed and ashamed of themselves. All right? It's pathetic. It's the only thing I can say. And again, I can only hope it's a joke. And it doesn't sound like it is, but I can only hope it's a joke. Okay? Because that's ridiculous. Don't be a victim. My goodness, it was your money and your wife's money that you spent. And then if the investor was not qualified, so what did you think? You have no experience doing something, and because you opened an account with Tastyworks, you magically, through osmosis, by opening that account, now have great, incredible wisdom? What? I got to move on. I can't even talk about it anymore. That's how much it pisses me off. All right, it angers me, and I rarely get angry. I usually feel pity for these people. This one makes me angry. All right, so let's move along. So today's topic, right, is don't give up on your trades. Okay, now I came across this because recently I've taken a few trades where this has been important. And while I'm doing so, or in doing so, I came across a lecture that I'd never taught, meaning I made up a lecture years ago, like 2 years ago perhaps. And you can see some of these, like Baidu, some of these are a little bit older. I don't know where Baidu is today. And I thought, you know what? This would be a good thing to bring back up because I'm seeing it happen. There's this mental block with people like, hey, I'm allowed to lose once on Baidu and I'm allowed to lose once on Microsoft, but God forbid I lose twice on Baidu. What? Wait, what? Come again? You're allowed to lose on different stocks one time each. That's okay. But you can't lose on the same symbol twice. That's not okay. Now, I'm not speaking to everybody out there when I say that. Some people obviously are okay with losing 5 times on the same stock symbol. I'm just making the point that there's this mental block with some people that because the symbol is the same, they're not allowed to lose on it more than one time. And there's this like negativity or this, I don't know what you want to call it, bad experience effect, and they won't get back in it. So when I look at this on Baidu, okay, this is a 2-minute chart, and it's the same chart. I just want you to see the line in the sand, okay? So it looks like a pretty good trade, right? We have a big green bar with a nice bottoming tail, and then the second bar here is a doji bar, and then this is the third bar. Well, for me, I happen to jump in just a tad bit early. Why? Well, the stock has a 10 to 20 cent spread. You can see right here it's a 19-cent spread. So instead of putting my order exactly at the high of the day, in this particular case, the high of the day was around 310.25, I believe it was, right there. This third bar right there, the topping tail bar, triggered me in, right? I had my order at like 310.05, and it filled me a little late, which is common with a 15 to 20 cent spread, right? So far we're looking at this, okay? And you're saying, hey, it's a pretty good looking 2-minute chart. So 310.15, 305.40. You can see the line down here. All right, I'm showing that to you because it looks like it's almost at 305. It's not. It's at 305.40, and that's why I put this line down there. You can see it's a little higher up. Anywho, you can see where it triggered me. See, this is not, look at the little chart here. This is not a topping tail when this happened. This was a green bar, and it looked very poised and ready to trigger. Yes, it did. Okay, so I'm like, I want a piece of this. I want a part of this. So I got in, again, slightly early, 10 cents early, maybe something like that, which isn't crazy on a 20-cent spread. And then what happens is it triggered me in and stopped me out. And note, look at the stop out, right? Look at it. There's the bottoming tail. I put a couple pennies under there, a nickel under there, and then ugh, right? Ugh. Lost $976.82. Okay, back at the time. So again, this was looking to go higher. And it didn't, right? It pulled back. Now, the first thing you're thinking of is, well, we have the 84% play. And we do, right? We've already talked about that ad nauseum. We're not going to talk about it today, okay? But we always have that in our back pocket. But do we always have to wait for the 84% play? No, the answer is no, but I feel like a lot of traders do. They're like, well, I stopped out the first time, and my statistics suggest that the 84% play works whatever percentage of the time for you it works, right? So I'm just going to wait for that. But why? Why do we have to wait for it? Where is it that says you have to wait for an 84% play? I mean, what if you get a buy setup, right? Lower high, lower high, lower high, bottoming tail 1, bottoming tail 2, doji bar. Why can't you get back in it? And the answer is you can. Get back in if there's a trade to be had. There's nothing that says you need to wait for that 84% play. Right now, you could have right there. You could have gotten back in at 310.15. It pulls back, chops around, and eventually goes. In this case, it's kind of 6 of this, a half dozen of that. It probably would have worked either way. But why not take the actual pattern that forms? And note, it formed where buyers stepped up before. I want you to take note where this bottoming tail on the left stops, where this second bar bottoming tail stops, where the fourth bar bottoming tail stops, and where the fifth bar bottoming tail stops. All right? So 1, 2, 3, 4, right? 4 bars, okay? The entry is 308 and some change. Stop is 304.50. Why? Didn't want to get wamboozled. Could you have put the stop at 305? Yes. Could have done a $3. I did a $3.50. So the point is I lost $976 on this. I got back in it and got my money back. You can see it right there. It's still going higher, 312. This thing eventually went to, I don't know, 317 or something like that. Okay? So when you look at this, the point I'm making is if you don't have the 84% plan in your tool bag, that's fine. Look for an alternative entry right here. There's another alternative entry right here, and there's another wedge breakout right here. So you have one entry here, second entry here, wedge breakout over here just before 11 o'clock, 10:45. Okay? So my point that I'm getting at is we looked at this stock for a reason. Perhaps the gap up, the daily chart, the relative strength. There was some reason that Baidu was on the list. And tried to sneak in a little bit early on a 3-bar play and got tagged. Okay, it happens. Does this mean you just forget about Baidu now? It's junk? No. I mean, you spent 20 minutes, 30 minutes in the pre-market scanning for this thing. And now all of a sudden you just throw the baby out with the bathwater? No. Stick with it. it will almost definitely give you another entry at some point during the day. In this case, there were 3 more. 1 here, 2 here, third one there. Okay? And it ultimately would have worked for pretty much any one of those. Okay? And oh, by the way, it eventually went to $346. What? Now, how would you have felt? Okay? What if you had taken, and by the way, the 5-minute 3-bar play worked on this. It took a while, but take a look at the 5-minute 3-bar play. Okay? Wide bar, narrow bar, triggers on the third bar, chop, 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 rip. And I mean rip, hip, 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 hip. Okay? So, yeah, exactly right, Brian, right? You should still have the higher time frame bias. So we're guilty, all of us, at some point in time, and part of the reason is emotion. We're upset. It's like, hey, screw that stock, F that stock, it costs me money, blah, 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 blah. But there's nothing worse in trading than losing on a trade, especially by a few pennies like this one, and then looking at it 2 hours later and it's $20, in this case $30 higher than where you got in, and you're like, wait a second, I was right, but my timing was a little bit off, right? I was right. It was a good stock to watch. But when you look at it in hindsight, you're literally looking at it going, there's nothing wrong with this. There's nothing wrong with this. There's nothing wrong with this. And there isn't anything wrong with it. But we're also looking at a 5-minute chart. If we go back, well, the 2-minute chart, I'll go back one more here. The 2-minute chart was actually quite nice, right? Go over to here. Pretty damn nice on this 2-minute chart. So it's not that taking the 2-minute 3-bar play was wrong. I just got a little bit ahead of myself and got in a little bit early. If you waited for a 5-minute 3-bar play, then it wouldn't have mattered, right? Because, well, it triggered and never stopped out and worked. The point, though, is stick with it, okay? Stick with it, all right? Here's another example. Here's a stock that you're looking at, and you're going, okay, XPEV. Chop, 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 chop. Looks like a breakdown right here, right under this pink line. 41.50 is the entry, 42.10 is the stop loss, low of the day, high of the day. It's a little bit of a choppy consolidation, but it definitely looks lower, right? It's a little bit of a choppy consolidation, but it definitely looks lower. So we have to keep an eye on this thing, guys, because it looks lower, right? I mean, there's nothing wrong with that. You're doing what you're supposed to be doing here, okay? But it doesn't always work out the way we want it to work out, right? Things don't always work out the way we want them to work out, okay? So in this particular case, all right, what happens? This happens, right? It immediately peekaboos lower, okay? And then does what? Comes back up almost near the high of the day. Right? It doesn't quite take out the high of the day, but take a look. I mean, you're pennies from the stop loss here. 5-10 cents from the stop loss right here. Okay? What would you do? Triggers your win by 2 cents, then turns out against you. Right? Triggers your win by 2 cents, then it turns against you. Would you have gotten out? When it starts to come back down, would you say, oh, I'm just going to walk away at break even? What are you going to do? Right? What are you going to do there? What you should do is follow your trading plan. So now watch. All the way back down. Right? So it triggered you in right there. I mean, just take a look at that. I mean, technically this is off a little. It should be right there. Right? That's the entry. Okay? So that's where you get in. And then comes all the way back up. Does not stop out. Gets a little dicey. Holds like a hair in a biscuit. There's the arrow, little topping tail, comes down. Now, I have been guilty of this myself. Okay? I have been guilty of this myself. Okay? And what is the guiltiness I'm speaking of? Having a stock almost stop me out. Hold the stop, come back to break even, and dump half my shares, sometimes my full position. I don't know about you guys, but I have been guilty of that. Because I look at it and go, well, it almost stopped out. There's so many buyers, it's strong. But that doesn't mean that those buyers are still there when we come back to the low of the day. They could be. But at the end of the day, it's just 1 hour. It's just one trade. So what if it would have stopped out? Would you get back in? or break your monitor? What if it almost stopped? Okay? Are you going to take half your shares at break even? Well, in this case, that would have been the wrong thing to do. It almost stopped, but it didn't. There's a reason we have support and resistance lines. Comes all the way back through the low there and just tanks. Pops, tanks. And it hit target in what? 4 minutes after it came back down? Okay? So you have to ask yourself, are you going to stick with it? Or are you going to get out because you're nervous and you're scared? Could you add? It's a possibility, Joel. It's a good question. Could you add below the low? Possibly, right? Possibly. I'm not saying you can't. Depends how it gets down there, right? In this case, maybe, right? It got down there in a pretty potent move, right? I'm telling this to you because I'm manifesting at times some of the things I do. And when you look back at it, you go, I had no real great reason to do that. The stock, because it didn't break the stop loss, was still weak. We saw the choppiness over here. So when we got in, it doesn't mean that the choppiness magically goes away just because we got in the trade. Does that make sense? So the trade was a little choppy before we got in. Bottoming tail here, topping tail here, green bar here, bottoming tail here, top. Why does it magically have to be the smoothest trade in the world just because we got in it? Or just because I got in it? It doesn't. And in this case, it wasn't. Peeped back up and then just tanked. Okay? So keep that in mind, all right? Another example, all right? This is a very, very, very nice gap, okay? Super nice gap. Doji bar, red bar, red bar, red bar, doji bar, red bar, pivot, okay? So you look at this gap and you're like, wow, I like this. It's a high level gap. Level 2 plus, level 1 minus, somewhere around there. Gapping just enough to get the job done, taking out all of these people on volume. I mean, very nice. So why am I saying all this about the gap? Okay. Because this gap allows us to be aggressive with the entry, right? So you might look and go, well, why would you ever take a 2-minute high? Because of the gap. Now, nowadays, I'm holding back more on 2-minute highs because the market has been very choppy, right? It's been moving much more volatilely, if it's a word. You get the point, though. The market's extremely volatile, so taking a 2-minute high is tough. But on this type of a gap, you could justify, right? You could justify that type of an aggressive entry. What happens? Comes right back down and tags me, stops me out, triggers me in by 7 cents, comes right back down, stops me out. Now, good gap, aggressive entry, stopped out. So does this mean this is no longer a good gap? It's crap now because 4 or 6 minutes into the day, right? 6 minutes into the day, this thing stops us out, so it's junk now. It's garbage. We're done. Screw this thing. The heck with that. No. Absolutely, unequivocally not. What happens? Makes us wait a little bit, right? It makes us wait a little bit, but pops, pulls back, retests, and gives us another potential entry. Now, normally, would I love this entry? Not normally, because it did break the low, but I love the fact that it retested that area. And with such a good gap, we see this very frequently. The computers, whomever it is, the funds, people, doing overnight orders, whatever, you'll see a nice gap and it won't run off the open. It'll chop around for 15 minutes, 20 minutes, and then it'll go higher for the rest of the day. We saw it on the Baidu trade earlier. The first 10 minutes a day, all the thing did was chop around. It was a nice gap, and then it went $35 higher for the entire rest of the day. So just because the stock doesn't act right off the open doesn't mean it's not going to be a good play. So in this particular case, I got back in on the double bottom retest, 55.84 by 55.60, 24.25 stop, went all the way back up. Get your money back and then some. The thing went to 56.70 or something like that. My goodness. I mean, that's a pretty nice move. You're looking at a 25-cent stop, and this thing went 85 cents. It's 3.5 R, right? pretty good. But if you smashed your hands on the desk and were pissed off, you're not getting this. You're just angry at this point. And then later on in the day, you're reviewing your trades. It's 3 o'clock, 4 o'clock, whenever you review your trades, and you're looking at that red bar and going, I can't believe it got me and went higher for the entire rest of the day. You could have bought the 2-minute buy setup over here. Maybe it looks better on a 3-minute or a 5-minute. Okay? But don't give up on your trades. Right? Don't give up on your trades. Here's another example. Aggressive trade stopped. So we're done. So here's a stock that had a wide range green bar. Okay? Looked like it was going to set up a 1-minute 3-bar play. Right? Wide bar, narrow bar. And then right here, we took an aggressive entry. Lower, high, aggressive entry. Right? 167.05 by 166.35. Okay? Aggressive entry. Pops up, rolls over, stops out. Pops up, rolls over, stops out. Pops up, rolls over, stops out. It was an aggressive entry. But that wide range bar, you're going to yourself, well, that's a pretty deep retracement on this pullback. Not deep, but right in that 50 to 60% range. So it really shouldn't pull back any more than that because the wide range bar should be potent enough. There should be enough buyers here for this stock to hold that area, that range, that bottoming tail. Well, it didn't. There's nothing else to say about it. It didn't. It stopped out. Okay? And then what happens? This thing then stops out, okay? And then gives you another pattern, another buy setup, another consolidation. Even if you didn't want to be that aggressive, this is a little bit aggressive, not crazy. If you don't want to be that aggressive, look at over here. Look at this 5-minute buy setup, right around 10:15. Thing ripped, right? I mean, it went from like 167.25 or something all the way to 171.50. Almost a $4 move on probably, I don't know, a 75-cent stop, something like that. So even if you didn't take this entry, which is the re-entry we took, right? We got back in pretty much on the 84% play, right around 167, give or take, with that stop, and the thing ripped. No problems, right? Dollar stop, less than $1 stop, and it went more than 2R. Boom. Pulls back, and this is where that buy setup is, right? This is where the 5-minute buy setup, right here, is where the 5-minute buy setup. Why give up on it? When you think about it, guys, it's a 1-minute bar. Does that 1-minute bar really ruin the stock for the rest of the day? No, it just ruined you mentally. The stock didn't think anything of it, didn't even know what it did, right? It pulled back, tagged us, put in a bottoming tail, and boop. So the stock doesn't care. It's not emotional, but you are. And therefore, because the stock did that to you, you have a different perception, a different opinion, and yet you were not objective enough to realize it only happened on a 1-minute time frame for like 20 seconds. Literally 20 seconds is what tagged you out of this trade. And then for the next hour, the thing went straight up. No, for more like the next 2.5 or 3 hours, it went straight up till about 1:30. So by 9:45, you were out of this trade. And then for 3.5 hours, this thing ripped higher. But that 20-second bar right there tagged you out. Be a professional. Keep your eye on it. There's a reason you took the trade to begin with, right? There's a reason you did that. That reason likely still exists. It may not, but it likely still exists. Okay? We do this all the time. And you know who does it too? Unmo. We all do it. We all do it sometimes. Look at GME. Wide range bar, narrow range bar. Unmo sneaks in right there. Right there. Gets in a little bit early. There's the call. Right? 153.26 by 150.88 at 9:33 in the morning. Okay? 153.26, right in that range. Okay, sneaks in right there. Probably got you in like right about there. Okay, right on that bar right there. Probably put this right there. Okay? So there's the entry. Oh, shit. Cancel. All right. There we go. All right. So there's the entry. Chop, 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 stops. That's it. You're done. GME is breaking over this pink line. Right? You guys never got back in GME. You talked about it. You never got back in. You never touched it again. But it's over this pink line. topping tail, pivot, pivot. Over here's a pivot. Yeah, a tiny little topping tail over here, but all in all, over that pink line is a pretty good place to be. Why give up on it? Well, I don't know. Because this thing went all the way back up on a different entry. Lower high, lower high, lower high, lower high, bottoming tail, support. In fact, I should put this over here as well, right? Let's just take a look at that right there. Okay, let's leave it there. Why wouldn't you get back in it? Look at that daily chart. And believe me, you guys know this. I can't stand meme stocks. Cannot stand them. But the chart's the chart. The chart is the chart. You're breaking through this pink line. You know you have at least room back to 154 because that's the high of the day. Yes, there's a little overlap on that bar, but you have the bottoming tail, the doji bar, 50% retracement, top pivot, bottom pivot. You're also sitting here at price support, minor price support. You get in at 150.60, your stop's 149.15. You have yourself a, I don't know, $1.40, $1.50 stop. Boom. It's already up $2.20 here. Wow. Why? Because the daily chart didn't change at all. This 5-minute chart, 1-minute chart, I think the other chart I showed you was a 1 or a 2-minute chart. So what? Overnight orders need to be filled sometimes. The first 10 minutes of the day are whippy and choppy sometimes and sloppy. It doesn't have a bearing on whether or not the rest of the day is going to be better or worse because the daily chart's still intact. Now, again, there are exceptions, right? If a stock just tanks $7, that might give you a different opinion of it. But not like this, right? Not like this. We all do it. We're all guilty of it. And this stock paid out. It absolutely paid out. It went above 155 yesterday. Got to get back in, guys. Don't give up on your trades, man. There's a reason they're on your list. 60-minute chart looks good. Daily chart looks good. Relative strength is there. Climactic set, whatever it is. There's a reason they are on your charts. Your thumbnails. Don't give up on them. Okay? We talked about this last week or the week before. The need for simplicity, objectivity, and self-responsibility. The market's not out to get you. Be mindful of what you're thinking in real time. This is the ability to evaluate what is happening in real time without letting your emotions control your... Read it again. Mindfulness, the ability to evaluate what is happening in real time without letting your emotions control your decision making. Read it one more time. Perfect patterns rarely fail. Well, sometimes they fail, and you need to get back in the trade and look for another pattern. Right? Same here. Due to your past and present actions, you are where you're supposed to be. If you are unhappy with that, then it's up to you to change it. If you are unhappy with your trading, it is up to you to change your trading. No one else knows what's going on in your mind. It's up to you to be objective, be mindful about it, and then talk to other traders and say, look, Jared, this is what's going on with my trading. What do you think? What's your opinion of this? How can I be better? Right? It's not rocket science. Anyone can do it, but most of you are not going to put the work in. So getting back into your trades, not losing sight of why the trade was on your list in the first place, that's being mindful, right? The market's not out to get you just because Meta, Facebook got us by 7 cents, I think it was what it got us by. It's not out to get you. It doesn't even know you. It doesn't care about you. And then it goes back up $5, $4, whatever it was. This is a very powerful slide. Again, I believe I put it in last week. Reread it. You need to understand yourself first. And that's where backtesting stuff comes in. For example, every trade you take, right? You go at the end of the day and you put it into your trade tracking spreadsheet, correct? Just nod your head, yes, that's what I do, Jared, even if you don't. Yes, you do, right? You put it into your trade tracking spreadsheet, you journal it. Ask yourself how it looks at the end of the day versus when you took it, right? Maybe you stopped out on it, maybe you didn't, but take a look. Did that trade generally trend higher or lower most of the day? And if it didn't, was it market related or did it just not work? Because sometimes they just don't work. But my point I'm asking or getting at is, if you do stop out on a trade, absolutely go back and see what that trade did 3 hours later. And then you might start seeing a trend, a pattern going, you know what? Most of the trades that I take ultimately go in my direction. Now, I say it here all the time. For Unmo and I, 80+% of the trades we take, even if they don't work, 80+% of them go in the direction that we intended them to go. We just got the wrong entry or the wrong timing, or maybe there was some market news that flashed us out at that moment in time, etc. and so forth, right? So don't give up on them, right? Don't give up on them, all right? Your personal opinions, situation don't matter about you getting in or not getting back in the trade. Doing the right thing is the only thing that matters. It just doesn't care about you. I'm not even going to spend any more time on it, okay? Saw this one last week too. I'm rehashing it because I think they're so important. You're not born an expert at anything. The only thing you're born an expert at is pissing and shitting. Okay, you're really good at that when you're a baby, like a pro. Okay? But other than that, you're not very good at anything. Everything you know in life is some product of your environment, someone teaching it to you, you overhearing it somewhere. Maybe you have a concerted effort to want to learn more about it, but the point is you are made. You are not born. This isn't to say some people are born with a easier time doing math problems or a better physical attributes. I'm not saying that. I'm just simply saying most of everything you know in life was made. It wasn't born into you. Okay? That's a good thing because that means you can become a great trader. Right? Through purposeful effort, purposeful training, getting back into trades that perhaps you normally wouldn't get back into, right? All of these things matter. How you approach the business matters. The level of effort you put in every day, it matters. Not ignoring trades that stop you out matters. And why is this so hard? It's so hard because we somehow, some way, because we're people, I suppose, we take stop outs personally. There wouldn't be a word called revenge trading, right? There wouldn't be such a phrase, revenge trading, if we didn't take stop outs personally. Because there would be nothing to get in which to extract revenge from, because it's not personal. Revenge typically means something that affected you or inflicted you personally. It's why you want revenge. But a trade stopping out is no reflection on the market or the stock. It's a reflection of you. So you're just getting revenge on yourself? Well, that's strange. Think about it. Really, give it some thought. We wouldn't have that term revenge trading if you didn't take stop outs personally. Don't. The market doesn't care about you. Doesn't even know it stopped you out. How could it? So go back and reevaluate the trade and ask yourself, well, the reasons I initially got in this trade, do they still exist? The gap still looks good? Market conditions are still decent? Well, gosh, maybe I should reconsider getting back in this if it gives me another pattern that looks good. I have no personal ill will towards this. I'm just looking at the chart. Don't really care what the symbol says on the top, just looking at the chart. Okay, get back in, assuming it gives you a pattern to do so. Okay? Don't take it personal because the market doesn't know. And remember, you're not born a great trader. You're made into a great trader through your personal efforts, through purposeful training, through getting help, through being mindful and being objective. Because if you're not objective, you're not going to know when to get help. You're going to think like that person in When Will the Insanity Stop? You're going to think you're just a victim all the time. You're not a victim all the time. You just need to make better decisions and better choices and learn from the things that happen to you. We all have bad stuff happen to us. And you know what? Sometimes it's just bad stuff that happens to us. But at the same time, we were in that place at that time. We put ourselves in that place at that time. So at the end of the day, it still was our fault, even if it's a very unfortunate circumstance. So I choose to look at the world that way. Because I want to have control over my future in some capacity, right? I don't have total control over it, but I want to believe I have some level of control over it, because if I don't, well, gosh, then what am I doing, right? I can't make any changes to be better if I'm always a victim of something. And I can never be better because it's not my choice in being a victim. You see what I'm saying? So don't, right? Don't. Take responsibility for your actions. Even if you did get hosed, even if you had something really bad happen to you, try to take personal responsibility and do the best you can to move forward. So, I hope you guys learned a little bit about why it is important to get back into your trades when they provide you with an alternative entry point. Why it's not good to get overly personal with your trading. Okay? Yes, I understand this game is very mental, psychologically based. I get it. But you're not doing yourself any favors. You're not doing your bank account any favors by making it a personal game. Right? Oh, this time it's personal. It's not, though. Right? It's not like you can see, Roger Federer across the net in a tennis match. He's the one who beat you. You can see your enemy. In trading, you don't know who your enemy is, so there's no point in even thinking about it because it's not your enemy. You can't look at the market as your enemy anyway. Why can't you do that? Because the market is actually here to pay you money. The market is your vehicle to make money. So start to love the market. Learn to love it because it's how you're going to make money. So don't make it personal. Get back into trades that give you alternative opportunities to do so. Don't be emotional when you stop out. It's okay to have damn it, that stopped out. Okay, fine. Move on as quickly as you possibly can. And guys, I'm no dummy. I know you're going to have some tough ones where they tag you on the penny and then rip higher and work. I get it. Move on from it as quickly as you possibly can, because that's the best path towards productivity and becoming a better trader. All right? So I hope you guys learned a little bit today. I'm Jared Wesley of Live Traders. We'll get back at it again next week.